Assalamu alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So if you all have been watching the stock market, say for example, since the beginning of the year, you might be thinking there are no opportunities out there, there are no undervalued stocks out there to buy. And I just want you to understand why we're always talking about the undervalued stocks. And the reason is because you want to buy stock when it's down. When it's down, other people have kind of washed their hands of it. They don't want anything to do with that company. Because these guys are more or less like a day traders, these financial advisors who buy and sell stocks in and out because they're looking for momentum, they're looking for quick money. But for us long-term investors, it's very important to be a value investor, buying high quality companies when they are very much discounted. You buy them, you hold them, and you're definitely bound to make some good money, inshallah, in the long run. And just for that reason, I'm always looking for undervalued stocks. Hence why I always like to share that with you guys whenever I find some. Now, I found about over 15 different companies that are undervalued at the moment. I will, show you where you can get your hands on basically on that towards the end of the video. So stay tuned for that. But right now, we're going to talk about 5 different companies that are undervalued at the moment. Okay, and these companies are really good companies. Some do pay some dividends, some do not pay any dividends. They're more high growth companies, if you like. And as you can see here, the S&P 500 year to date is up about basically 17%. It's almost 8% for the Nasdaq, for Dow Jones, and 20% or 18% for the Nasdaq. Even good old FTSE 100 is doing really good this year. So you might be thinking there's no opportunities out there, but I would like to show you that, inshallah. Now, before we move on, it genuinely helps the channel if you can join us with the Patreon account. What do you get? You get the Discord, where a lot of brothers and sisters are sharing good practices. I also share my buys and sells in here, and on the Discord I share my family portfolio, the entire thing. You've got the dividend trackers, you've got the dividend calendars, you've got stock watch listers, you've got the ETFs, you've got the Sharia compliant investing ebook, and then you get some more regular things that I share. So news that I share, things that I put together. A Sharia compliant investment, like a file that I put together, was like 5 pages recently. So I share all of these things in here, and it will cost you 15p per day, but it really helps the channel. But the most important thing for me is that the like button. Okay, what that does is the algorithm then informs other people who are very similar to us, who are Sharia compliant mindset, who want to buy Sharia compliant investing and investments and so on, and it really helps the channel. Okay, it helps those brothers and sisters, and it will help us, inshallah, in the long run. Now let's get started and talk about these 5 companies that we said we're going to talk about today. And as always, please do your research. Okay, don't just take my word for it. Just make sure you always do your research. And basically the fact that it's undervalued is based on the Morningstar valuation. I will also show you what Seeking Alpha is saying as well. Okay, the first company we're talking about today is Autodesk. This is one of the companies that provides a 3D design, engineering, and entertainment technology solutions worldwide. So they are the company when it comes to, if you're an architect and so on, this is where basically you will go to this company and buy their software. They have a software as a subscription as well, which is quite nice to see. Right now their market cap is $53 billion. They have a wide economic moat. Price right now is $248 per share. They don't have any dividends, and the last 5 years they grew that revenue or compound annual growth rate of 15%, 66% when it comes to EPS, and profit margin about 18%, and return on equity 65%, return on invested capital of 26%, free cash flow 900 and closer to $1 billion. Okay, and then total return in the last 10 years 17%. So this is compound annual growth rate. Like, this is basically a per year. You'll make 17%. You had made 17% if you own this stock basically for the last 10 years. I did used to own this company in the family portfolio a while ago. It was undervalued. I bought it and it gone up quite a bit, and then I sold it and then it came back again. So it's very interesting company because I really like the business model. Growth estimate for the next year and the next 5 years is basically 11 to 12%, which is absolutely amazing. It's discounted right now about 10%, $275 per share is where they think the price should be. Now, if we look at the final basically earnings expectations, because it's important to see that. Okay, if we look at the earnings estimates, for example, this year they're expecting about 7%, so that is 2025 next year. Okay, but after that we are expecting And in 2026, we're expecting about 11, 12%, 15%, 28%, so double digits more or less every single year moving forward. But you just have to think about the first three are what I'm normally looking at, because these have more analysts looking at. So 23 different people are looking at this, 9 people, and the rest of them are just one single person. So I wouldn't pay too much attention to this. So that's the EPS, that's the earnings per share growth. And when we look at the revenue side of it, you could see double digits every single year. So this is really one of the important companies, and I really like it. I like the fact that it's discounted so much right now. And in looking at basically analyst expectations, the breakdown, 12 of them are saying it's a strong buy right now, 4 buys, 8 holds, 1 sell, and as you can see here, it's about 9% upside from where we are. Right, that's the first one. The next one is, no surprise, Lululemon. This company has been gone through so much in the last few weeks, months if you like. Basically, for a year to date, so almost down 50%, which is absolutely incredible. Okay, a year to date is about 32%, and the last 5 years is up about 45%. When you look at the last 10 years, you've got 538%. So it's just down. Just basically this year it's gone down so much. Okay, let's look at the financials. So 32 billion market cap, narrow economic mode, $258 per share. Now they don't pay any dividends. They grew that basically revenue of 24% compound annual growth rate for the last 5 years. Same 28% when it comes to EPS, 16% profit margin, return on equity 42%, return on invested capital of 40%, and free cash flow of $1.7 billion right now. Total return in the last 10 years, we're looking at about 21% if I can speak. Growth estimate next year 9%, then 11.5% every single year, that is, for the following 5 years. Now this is, remember, it's an estimation, okay, so anything can change. Right now it's discounted about 13%, $296 per share is where they think the price should be. Now if we look at the earnings expectations for this company moving forward, you can see it's double digits almost every single year for the next 3-4 years. Okay, even if you take this one into consideration, 22% also. Okay, even this one, there's 2 people looking at it. Okay, then when it comes to revenue side of it, 11% or 9% to almost 10%, 12%. So really solid growth moving forward. There's nothing huge. Of course, it used to do better than that, and that's why a lot of people sold it. But in my opinion, 10% of EPS growth and 10% revenue growth, that's really good. Like that's a mature, solid company, you know. So let's look at the ratings moving forward. As you can see, Seeking Alpha is a buy, Wall Street is a buy, Quant is a hold. So the buy, 17 strong buys, 4 buys, 11 holds, 1 sell, and 2 strong sells, and about 38% upside from where we are. $356 per share is where they think the price should be. Now the following company is Hershey Company. This is again another misfortune because of the cocoa price going down and so on. The margins have gone down quite a bit, and they spending a lot more money buying those cocoa. So for that reason, the margins got squeezed a little bit, and for that reason, a lot of these short-term investors gone out of this stock, which is good for me because I've been buying, and I'll share with you guys basically how many shares of this company I own, inshallah, towards the end. If you have not liked the video yet, please do so. It really genuinely helps the channel. If you don't want to do anything else, just basically like the video, subscribe, inshallah, and you will reach more brothers and sisters out there. So as you can see, for the 1 year, we're down about 11%. For a year to date, we're down basically up about 3-something%, which is not bad. Okay, so it's okay. It's not that bad. It's not as bad as they make it out to be. Okay, and right now, as you can see, almost 14 billion market cap. Wide economic mode, $193 per share. Dividend yield of almost 3%, which is really good. Payout ratio only 57%. Latest increase was 15%. 5 years is basically 10%, and 14 years of increase in that dividend. Now, the annually you get $5.48. Safety right now is 80%. 5-year growth rate for the revenue is 7%. In terms of EPS, 8%, profit margin 16%, return on equity of 47%, 48% almost, return on invested capital of 26%. So this is absolutely a profitable business that is run very well. $1.3 billion of free cash flow. Total return in basically last 10 years, 10%. They expect basically the earnings to grow basically negative 2% this year, and then 1% every year for the next 5 years. Now this also depends basically depends on a lot of things. Okay, if we hit in a recession, even it might get worse. If we don't hit in a recession, basically a recession, and things are better and people are buying these snacks this company has and so on, then of course it will change. Okay, 8% discount right now, $210 per share. Now if we look at the earnings side of the company, okay, and see what to expect, what these guys are saying, as you can see, they basically these 2 years, so 2024, which is almost a write-off, 2025 more or less exactly the same, and then 2026 and 2027 and so on is started to pick up that 8-9%, which we expect from this company. Revenue more or less the same, 2% growth, 3% growth, 3% growth. So the things have slowed down slightly because this company was about 7%, 8% every single year in terms of growth side of things, but right now absolutely no issues to worry about. I like the company. I'm going to hold on to it and I'll share with you guys how many shares of this company I own at the end. Then following company is Taiwan Semi. This is probably one of the most important companies out there, with Nvidia and all of these companies basically coming up with all sorts of AI chips. None of them will be able to do what basically anything if this company actually they cease to exist. Okay, so they all go to this company, tell them their design, and this company makes it happen using ASML equipment. Now market cap is $780 billion right now. It has a wide economic moat, $174 per share. Dividend yield of 1.4, which is quite nice for this type of company. Payout ratio 42%. Latest increase of 14%, the 5-year growth rate of 10%, and 1 year straight basically increasing that dividend. So they don't really care, they just increase it whenever they can. The annual payout is $2.47, safety 62%, the 5-year growth rate in terms of revenue side of it 17%, 30% when it comes to EPS, profit margin 37%, return on equity 26%, and return on invested capital of 21%. Now free cash flow yield, we're looking at about $14 billion right now. Total return the last 10 years 25%. Growth estimate next year 26%. Growth estimate next 5 years we're expecting 22%. 18% discount, $213 per share is where they think the price should be. And looking at the company, this is probably not down. Okay, this company, look at this, strong buy from quant, strong buy from Wall Street, and a buy from basically Seeking Alpha analysts, which is absolutely amazing. They're not down, as you can see, a year to date 67%. So for the 1 year 90% up. For the last 6 months they up 37%. So they're not down, but because of the growth or your basic expectations for this company, that's why this team is still undervalued. Because look at this, 26%, 26%, 12%. Absolutely huge company. Now if you are Sharia compliant investor and you are actually based in the UK, you cannot buy it through a trading 212. Now I bought it and I do own it in the trade, basically in the ISA account with the interactive brokers. Okay, I didn't think that was a thing, but I saw it, I bought it, it's there now. So yeah, I'm not sure why these guys are not doing it, but the other guys are doing it. But I'm buying the US version. I'm not buying the Taiwan semi version of it, and that's not available here. Okay, so the US version of it is available on interactive brokers, and that's where I own that stock. So if you do not basically have it here, maybe if you wanted the stock, you can check it, or you can actually forget all of that and buy the S&P, buy the ETF that tracks the basis of the semiconductors, the SMH, whatever it's called, and that one will track it. Basically, I think there's I don't know how what percentage of this company is in there, but you can buy it through there. If you live in the US, then you have absolutely nothing to worry about. Right, so the final company we're going to talk about today is UPS. UPS is one of the companies that have been down so much this year. And a lot of it is because basically the business slightly slowed down because of recessions and everything. Remember a few years ago, everyone was at home basically getting delivered things and so on. And Amazon basically delivery is taking a share of this company. Then there's a union situation going on. So there's a lot of basically headwinds for this company right now. But in the long run, I think this company will bounce back. As you can see, it's about 17.5% down for the year. 1 year is about 14% down. Last 5 years, basically, it's about 12% up. And the last 10 years, about 32% up. So this is not by any means a high growth company, okay? So you need to remember that. Now, in terms of market cap, $111 billion. Wide economic moat, $129 per share right now. Dividend yield of 5%, which is absolutely huge right now. but the payout ratio is gone up so much, 90%. It makes me worry a little bit. Latest increase is basically 1%. The 5-year growth rate about 12%. They have increased that dividend for 14 years. $6.52 is what you'll get. Safety 69%. So this to be basically, this means for me, I don't really care whether it's 90%. I do care, but I'm not worried. Okay. So the fact that the safety is 69%. So that means the net income of this business hopefully will cover majority of that dividends. Okay. And hopefully they can start reducing this in a bit. And once they have a bit more cash and so on. And as you can see, the growth side in terms of revenues are about basically 6%. In terms of EPS, negative 3% in the last 5 years. Profit margin about 5%, 8% almost. Return on equity 28%, and return on invested capital 17%. So this side is absolutely fine. This year, profit margin not great, but free cash flow of $4.6 billion. For that reason, I'm not too worried about the dividends. They're not going to cut their dividends anytime soon, I hope. Total return in the last 10 years, 6%, 20%, and then 3% after that. So they expected to grow about 3%, but this year coming about 20%, 14% discount right now. $150 per share is where they think the price should be. Now, if we look at the earnings expectations moving for this company, right? 2024 is all we already knew as a kind of write-off, but look at this one here, 20% for the following year, 2025. And then remember, there's 17 people looking at this one, about 16%. So this gives me hope. If this happens, I'm sure these analysts will change their mind and the stock will basically go up straight away. But this year is a write-off completely. So, and we're already in August, so I'm not too concerned about this year. The following year, basically for the revenue side of things, about 1%, and then the following year they're going back to what they have done for a very long time. That's about 5% to 10% growth, which is fine. And again, more or less the same in the following couple of years. So I genuinely don't have anything to worry about the company. And in terms of ratings, as you can see, is a buy, and here are, so it's 13 strong buys, but 2 buys, 14 holds, okay, 1 strong sell and 1 strong buy, and right now 12 to 13% upside from where we are right now. Final thing I want to show you is from Sharia compliance side of things using Zoya. So as you can see here, these are the 5 companies. You can pause the video. The only one that slightly has higher interest-bearing debt is this one here, UPS. Other than that, they are absolutely fine, all of them. Now, if you enjoy this type of content, I appreciate if you could genuinely join us on the Discord, and of course join us in the Patreon account first, get access to all of these things, and share with the brothers and sisters out there, inshallah. And please don't forget to subscribe, to like the videos. And what I'm trying to do here is help the the Muslim Ummah. If you help me, inshallah, we can help more brothers and sisters. Put it just that way. Have a wonderful day. Assalamu alaikum.